Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's invite someone who's a doyen of the bond markets, Prasanna, Head Global Markets Group of ICICI Bank. Good morning, Prasanna. Pleasure having you with us. What have you taken away from the rate stance, the rate hike and the inflation forecasts? What does it hold in terms of future action from the RBI?
So, Lata, going into the policy, the background was of domestic imbalances as well as external imbalances. The external imbalances were coming through the weakening current account deficit and the depreciating rupee against the dollar and other currencies as well. And also the internal imbalances which is happening through increasingly higher core inflation and the gradual closing of the output gap. So from that perspective, when these two imbalances were there, it was necessary for RBI to take an action. And most of the market participants were sure of a rate hike. It was a question of timing. You could quibble on whether it could have been done this policy or the next policy. So it is appreciable that RBI actually went ahead and hiked rates, kind of reinstated the inflation fighting credential. And also from a financial stability perspective, I'm sure this is a rate hike which will give a lot of international investors a lot of confidence in the ability of the central bank to fight inflation, as well as the capability of the central bank to guide macroeconomic factors to a better level. So I think that's the background to the policy, so a well appreciated hike that had happened. As far as the hike is concerned. So as far as the stance is concerned, yes, there have been a lot of discussions and arguments as to whether a hike is really warranted when you are still in a neutral stance, and how can you actually do two consecutive hikes when you're still in a neutral stance. So I personally do not feel, I'm not of that camp, and I personally feel that it is perfectly logical and consistent in having a neutral stance as well as hike rates, because I for one believe that the stance which is supposed to indicate is forward-looking and forward-looking at that particular point of time. So if the repo rate is 6.5 and the governor feels or the MPC feels that 6.5 is the appropriate valid rate at this point of time, it's perfectly logical to say that he could shift either way, and is completely dependent on data. So I think to some extent the indication is he's telling us that he'll be completely data dependent. He wants more data. If he has to do more hikes, he'll have to be surprised on the inflation front, and so on and so forth.
So how many more hikes are you penciling in, Prasanna?
See, actually the biggest takeaway for me from the policy was that he actually brought in an inflation projection for the next year, the Q1 inflation projection at 5%, which was not there earlier. So from that perspective, I actually feel now, and also you combine it with the fact that in the post-policy conference yesterday, they actually did away with the 150 to 175 basis point real rate argument. You kind of get a feeling that if you, and also with the statement of the governor, who clearly said that achievement of a 4% medium-term inflation target is supreme, and he did not mention about the plus or minus 2% target. So in other words, what he is trying to say is that achievement of the 4% target is sacrosanct, and when you are having an expected inflation of 5%, you would expect to be in a rate hike cycle. So I do expect a couple of more rate hikes. But what actually was positive for the bond market perspective was the fact that they actually went ahead and said that there is a lot of lags for the rate hikes that has already happened. So giving the impression that maybe they'll stay pat for the next one or maybe two policies and look at rate hikes only as late as February. So according to me, the cycle, there might be two more rate hikes, but I don't think the next one or next two policies might have a rate hike.
Okay. Well, let me come to liquidity. The Deputy Governor explained how he had handled liquidity up until now. He didn't speak about a guidance on liquidity. Do you think they will allow liquidity to tighten? He did indicate that in the festival season, a lot of people withdraw money, and therefore there will be a natural tightness. Do you expect them to keep it a little tight? Keep y'all going, borrowing in the LAF window at the repo rate? You think that will be the scenario?
So yeah, so actually there are two things on which I probably did not get full answers. The first was, see, normally in the past, RBI has always said that when there is a deterioration in durable liquidity, then RBI will try and provide durable liquidity to the system. And by that, they meant that if there is a liquidity deterioration on account of either currency leakage or on account of FX intervention, then they'll try and infuse money either through the FX swaps route or through the OMO route or technically through the CRR route earlier. Now they have, of course, ruled out the CRR route, so it only remains, you only get the FX route as well as the OMO route. So that was one answer. I mean, why have they not done a higher run rate of OMOs than what they have already done is a question that I probably didn't get a full answer to. And the second thing is also that I suppose that when they look at liquidity projection, they look at it only for the next fortnight or at best for the next month, because whatever said and done, there is a lot of uncertainty about which way the FX flows are going to move. It could very well happen that we could again get back a lot of flows going forward. But my own assumption and my own estimate for the next year is for liquidity to deteriorate substantially even from now till end of the year. So far we actually have a swing factor of a negative 2.5 lakh crore of deterioration in core liquidity. But the fact that the government has actually spent and increased its WMA overdrawn balances has actually helped the system. From an overall system perspective, it is not so much deficit. But going forward, like the governor, deputy governor himself alluded to, it's quite possible that the CIC leakage will continue because of the festival related drawals. And you don't have a government's capability to spend beyond that WMA anymore. So which basically means that there will be a gradual deterioration of liquidity in Q3 and Q4. And hence from that perspective, it is very important that they decide in their minds as to how much of open market operations they can potentially do. In our own calculation, for example, we see a liquidity deficit to the tune of 2.5 lakhs to 3 lakh crores coming in, but I don't think it's feasible for RBI to do open market operations to that extent in the GSEC market, because then that will destabilize the market in terms of artificially propping up the yield. So maybe our estimate is in the extent of 1.5 lakh crore of OMOs going forward. So the interesting thing is that still leaves a gap of around 1 lakh to 1.5 lakh crore of deficit in the system by end of the year. And my assumption or my understanding would be that I don't think RBI is going to come out and spell out their liquidity stance in so many words. They might probably leave it for the market to, kind of keep guessing as to what kind of liquidity levels they are going to target. And since the OMO run rate is not going to be as high as the kind of deficit number that I'm projecting, it's very possible that in Q3 and Q4 you will have a system deficit, system liquidity that is continuously in deficit, which the market has to grapple with.
So, I mean, we have to wrap it up because the markets are going to open. But therefore, what will the rate look like? Yesterday, we actually saw the yields falling after the announcement of the rate hike. Now you are talking of maybe two more rate hikes in this cycle. Other experts who came also said the same thing. And you are talking about a liquidity deficit. So do you think yields are going to be much higher? What is the guess by December, say?
So Lata, I think it might look very counterintuitive that bond market actually rallied yesterday when yields were hiked. But what was more important than the rate hike itself was what kind of language the governor used in the policy, the MPC used in the policy, and what kind of stance there were, and what kind of language they used in the post-policy press conference as well as the analyst conference. And I could say that I was pleasantly surprised that there was a consistent sprinkle of dovishness, or rather less hawkishness in all these factors. And they didn't allow the market to get any idea of a series of rate hikes. So when that is taken away, and also remember that we are coming from a really bearish phase in bond markets where yields have really gone up by 150 basis points over the last 1 year and 50 basis points just in the last 3 months. It is also a kind of sell on rumor, buy on news kind of scenario where market it was a relief rally and market went and bought in bonds. So the neutral stance change, the continuation of the neutral stance, the relief rally, as well as the fact that the monetary policy lag argument which was given by the deputy governor post the policy gave the comfort that you don't have the next set of rate hikes anytime soon. So if you have a rate hike in February and April, I mean, anyway, a lot of things can happen before that, and we could always revise our view based on that.